But Dan, we've seen Bank of England hold interest rates. They're at 3.75%. It was a bit of a knife-edge decision. What does this actually mean for not only investors but voters who, you know, have a mortgage to pay, their savings rate maybe is falling? What's the knock-on implications of this Bank of England decision?
Yeah, Kaz, it's great to chat to you, and thanks for having me on the show. You're right. With any interest rate decision, there's no single impact. There's a lot going on beneath the surface. So almost nobody in the country is either just a saver who benefits from higher interest rates or just a borrower who benefits from low interest rates. And so the impact of the Bank of England holding rates will be somewhat nuanced, but I think the most important thing for investors is not to try to draw simple stories from the analysis. So we know that interest rates tend to be put down when the economy or the financial system is in trouble. So first of all, we could draw some comfort from the fact that the Bank of England doesn't think that the UK economy, that UK savers and voters and consumers are in trouble. That is inherently a vote of confidence. Next, it's a sign that they're confident that inflation is roughly on track. We all remember the feelings we had when inflation was running away, particularly energy price inflation a few years ago, and the energy crisis that so many of us faced. And the good thing about the Bank of England holding rates where they are is that they think that inflation is under control, and that should give us some confidence as well. Of course, it's not so good for people who have variable rate mortgages because they'll want to see interest rates coming down. But again, a lot of people today have fixed rates or discounted rate mortgages, and so it won't just be a one-to-one impact on most consumers. So in the short run, there's plenty of good news there, and also, of course, short-term interest rates inherently lead into long-term interest rates, and this is something that is easy for us to forget, that the immediate interest rate is just 1 point on a long curve of interest rates that stretches out almost 50 years. You can lend money to the government or lend money to other institutions at various points along that curve, and so from a saver's or borrower's perspective, then it's not just what's happening at the very short-term interest rate level, but also longer term. So if you are a mortgage borrower and your fixed rate mortgage is coming to an end, then probably the interest rate at the 3 or 5 year level is going to be of most interest to you. Again, that hasn't moved around too much. That's quite a good thing. And again, if you're locking savings away, then probably the 1 year interest rate or the 3 years is relevant to you as well. So I think the most important thing thinking about interest rates is to remember that there are two sides to your personal balance sheet. There is your savings, which benefit from higher rates, and again, your wages may benefit from higher rates as well, because that's typically when the economy is doing really well. Bonuses may be beneficial, but also most of us are borrowing money in some capacity, and of course we benefit from low rates. So it's pretty nuanced, but the result we saw this week should give people some confidence that the Bank of England is not worried about the future path of the economy, future path of inflation. We have a sort of period of stability. So broadly good news. But just remember that we can't ever take that for granted. When thinking about investing, particularly, you have to prepare for a wide range of outcomes. The Bank of England isn't always right in its long-term assessment.
The Federal Reserve is obviously going to go through a period of movement in the next couple of months. Jerome Powell's term will end, I believe it's in May. Trump has put his nomination forward for a low interest rate Fed chair. Why does Trump want interest rates to fall in the US? Because I think what a lot of people in the UK may think is Rachel Reeves has a hand on the tiller that also controls interest rates, and that's actually not true. But what we're seeing in the US is a lot more of the kind of merging of power, almost, where Trump is influencing which should be independent organizations. So just talk me through what's happening with the Federal Reserve in the US, and then how politics influences central banks and how they set the interest rates.
Yeah, sure. So the first thing to say is that although the Bank of England is really important to us, in reality, the Federal Reserve, the US central bank, and within the Federal Reserve, the body that sets interest rates, known as the FOMC, they are the most important interest rate setters across the globe, because they don't just set interest rates for the US, but of course the dollar is so ubiquitous around the world that in some ways are setting interest rates for all of us. So an incredibly important institution. People are watching what happens in that central bank even more carefully than any others around the world. And one of the greatest innovations in financial history has been the independence of central banks. I remember back in my youth that interest rates for the Bank of England was set jointly by the government and the Bank of England. And of course, the Labour government came in 97 and made the central bank, the Bank of England, independent. That was incredibly important. And the US has had an independent central bank for a long time. And so that independence of the central bank is really important, because it gives us confidence that the bank will be working in the best interests of the economy and not the best interests of politicians. And some of the problems that we've had with inflation, particularly in the past, you go back through the last sort of 100 years or so, there's been periods of very high inflation. A lot of that can be traced to central bankers and politicians who were driving interest rates in the wrong direction, against established monetary theory, in most cases, established economic theory in most cases. So that was a problem. It was a problem that was resolved through the independence of central banks. And of course, one of the concerns of investors now is that is being challenged in the US, and it's being challenged through President Trump being very clear that he wants a chairman of the central bank, a chairman of the FOMC, that's going to drive rates lower. Well, he's picked someone, and people are getting terribly excited about it. But in reality, I don't think we should focus too much on that, because the chairman is very important, but they're only one person on the FOMC, which is staffed by other Federal Reserve employees, governors who are on rotating terms, and so it's going to take a while until you get a collection of governors that are aligned to that view. It's a body that is very independently minded, and also a body, I think, that's very clearly focused on doing what it believes to be the right thing for the economy. That doesn't mean it always gets it right, far from it. But I think even with a chairman who seems to have been selected because of their willingness to acquiesce to President Trump's desire for lower interest rates, at least in the interview process, that may not translate to any changes. And that is really important, because what every politician wants, and obviously President Trump included, is continuing power. Now, the president has important midterm elections coming up. I'm not a scholar of US politics, but nonetheless, we know that those midterm elections are very important, because the administration is concerned that they'll lose both houses of Congress, and that will restrict their ability to get things done in the second part of President Trump's second term in office. And so one of the ways that politicians, particularly politicians in power, try to gain the confidence of voters is through having a strong economy. Now, interest rates can sometimes act a little bit like paracetamol. You know that if you wake up in the morning and you're not feeling great, you've got a bit of a cold or something like that, then often we can just pop a couple of paracetamol and we'll feel good for the next 4 hours. It hasn't solved the problem. It hasn't made our cold go away. It's just given us a bit of a pep up first thing in the morning. And sometimes having unusually low interest rates can give us that bit of a pep up. And obviously, President Trump is hoping that pep up happens just about the time people are trying to work out who they're going to vote for, and that will give him an advantage. So this is not new. This is not isolated to President Trump. Every politician's trying to do this in one way or another. We see it in tax policy in the UK as well. So this is not unusual, but it is why having an independent central bank is so important. And so again, one of the drawbacks of having that little pep up is you tend to feel a lot worse later on if inflation comes through the system because interest rates have been too low. So it's perfectly logical. That's what President Trump is looking for. I think it's unlikely that the Federal Reserve will be driven to lowering interest rates to unusually low levels to support that, and you can see that in markets. So one of the things that we can all access is an estimate of what interest rates are going to be by the end of the year in the US. These are forecasts that are out there in the market and expressed in prices, and if you look at those today, then people are expecting 2 to 3 interest rate cuts over the course of the year. So they are expecting interest rates to come down, but not by a lot, and certainly not enough to have that sort of paracetamol boost that President Trump is looking for.
I think the other aspect that people may not fully consider, and this is drawn back to your point of independence between central banks and government, is that interest rates also make governments, they give them more wiggle room in their budgets, because obviously it then makes debt cheaper. This has been something where Rachel Reeves has been criticised, a lot for some of the policies that she's brought in, and her decisions can be wiped out with an interest rate rise if debt gets much more expensive. And obviously for Trump in the US, they've got significantly more debt. So would you say that this could potentially be it's an economic play for purely political benefit, because if he can bring the debt repayments of the US down, he can put more money in US consumer pockets? Is that the narrative you think he's trying to carve out, or do you think it's purely economic, get debt as cheap as possible for businesses to do more?
So now we're getting into deep political analysis, and so anyone that actually really knows the US political system will start laughing at me at this point. But here is my amateur approach to what's going on. So the first thing to note is that I mentioned earlier that the interest rates in the short term are important, but also you can lend money to the government over very long periods of time, and different governments choose to raise the funding they need for spending in the debt markets at different points in the future. So traditionally, the UK has favoured longer term debt that provides more clarity and security to the government of the day, and also is favoured by UK pension schemes as well. So they've got a ready buyer there for some of their debt. Whereas the US, which of course is a much more global market and dominant, as we mentioned earlier, they've tended to favour shorter term debt, and that tends to be favoured by the overseas investors that provide capital to the US and provide capital to the US government. And so first of all, we have to understand that the sort of debt shock that happened with the Liz Truss quasi-Kwarteng budget is unlikely to happen in the US because of the way that the debt is structured. Is much more is much shorter term. Second, it's always worth remembering that the two main political parties in the US, the Democrats and the Republicans, have traditionally had a different approach to debt, to taxing and spending. Traditionally, the Republican Party has been much more conservative. They've wanted to control the deficit, the amount the government has to borrow each year, and therefore ultimately limit the amount of debt growth. It never gets repaid, but debt growth that happens. The Democrats traditionally have been more focused on social programs, raising money in debt markets to look after people in society. That's obviously a gross generalization. But we now have a different situation because obviously the Republican Party under President Trump has been much less concerned about the buildup of debt, much more concerned about tax cuts. And of course, if you reduce taxes without reducing spending, then you increase the debt. And so we don't really have a strong pushback against rising debt in the US. Now that also has an implication for both the interest rate on longer term debt. If people lose confidence in the government of the day and their control of the debt mountain, then we could see some rising longer term interest rates there. It also, of course, can have an impact on the currency, and arguably we've seen that a little bit in the dollar over the last year, which has fallen relative to other currencies. And of course, we saw that writ large during that infamous UK mini budget. So again, when we look at the situation there, it's important to understand there's lots of different dynamics going on, but from an investor's perspective, the most important thing to remember is that there's a range of potential outcomes, that we shouldn't just focus on any one particular outcome, particularly one that aligns with our political views. And that's so important, because when faced with a lot of uncertainty, whether it's political uncertainty, it's economic uncertainty, it's market uncertainty, then naturally we tend to try to simplify things by thinking in terms of stories, in terms of narratives. That's really dangerous, because then that gets you hooked on one particular future. If you invest in line with that, you're likely to be surprised. We make terrible mistakes when we're surprised. And so it's important to think about everything that's going on, but don't get too focused on one particular narrative of how this will play out over time.
You mentioned the dollar has fallen in value, and under Trump, who was deemed to be quite a bullish crypto guy and a bullish crypto president, Bitcoin has since fallen. I think it's below $65,000 at time of recording, which means it's lost its Trump rally. So we're now in a position where we're back to square one under some of these asset classes Trump was meant to champion. Do you think we've hit the end of the Trump bullishness and we're all seeing the cold light of day of what the tariffs mean globally? And do we think with the midterms upcoming that maybe, Trump's natural pro-investment, pro-business, his optimism is faded pretty quickly?
So I think it's really important to isolate what's happening in cryptocurrencies. And here we're moving from deep political theory to deep investment theory. And when you think about investing, obviously there's lots of different choices that you have, but there's really two key choices in investing. You can either invest in an asset that generates a cash flow, and that might be a stock or share on the market, a share of a company which delivers profits. It might be interest from a bond, lending, or from your deposit account. It might be rent from a building. But all of these assets deliver you a cash flow, and because they deliver a cash flow, you can work out what a fair valuation for them is. And most of these assets, most of the time, tend to cluster around a reasonable estimate of their fair value. Now, you get periods when there's this kind of panics and exuberance, over-optimism, where they deviate from their fair value, but most of the time, they'll be around fair value. Now, then there's another class of assets which has value because it's scarce, and gold is the obvious example. That with gold, there's a limited amount in the earth. We pull it out of the earth, and because it's been a store of value for millennia, it is deemed to be a worthy investment. It doesn't deliver you any cash flow. In fact, it sucks in your cash flow because you normally have to insure it and store it somewhere. But nevertheless, you could argue that it is a long-term store of value. But because you can't anticipate what that value will be, you can't calculate or estimate that value, then we know that it's quite volatile. We've seen that over the last few weeks, where it's shot up and then down again and then back up again. It's quite a roller coaster ride. So you can have scarcity, you can have cash flow, and then you have cryptocurrency. And cryptocurrency obviously doesn't deliver a cash flow and arguably has no scarcity. And so when you look at a cryptocurrency, obviously proponents of currencies like, or crypto tokens like Bitcoin would say that there's scarcity built into the algorithm. That may be true. You have to put your faith in the algorithm and the folks that recommend crypto. But if we think about the cryptocurrency landscape as a whole, then there are millions of tokens that have been created, many of which have died. There's probably about 10 to 18,000 that are still living. The only logical value for something that has no scarcity and delivers no cash flow is zero. So we'd have to value the entire crypto complex at zero, and then there might be some exceptions over time that prove their worth in the way that gold proved its worth millennia ago. And so when we think about what that means for crypto price of the last couple of weeks, is it's impossible to say what the fair value should be. There is no floor. So if Bitcoin went from $65,000 down to zero, does that mean, or down to $1, let's say, does that mean it's undervalued? No, not necessarily. If it went to $1 million a coin, does that mean it's overvalued? No, not necessarily. Which means it's almost impossible to invest in. You can own it. There's nothing wrong with that. It's not illegal. But you can't assume it's going to deliver you a return over time because the price is so volatile, and there is no way to estimate what its fair value is. So yes, what we've really seen over the last year, as you say, is initially people expected the positive sentiment that came in with the Trump administration to boost cryptocurrencies. More recently, we've seen them fall off, and that's been alongside declines in other, let's call it technology-related assets that we've seen over the last few months, as well as people being concerned more generally about what's happening in the technology sector, the impact of AI, the impact of all the capital investment that's going in around AI, and as that's soured, then that sentiment has been felt with cryptocurrency. But it may rocket again tomorrow. It may drop another 30%, and that may be fun for some people that own it. Certainly, if it's rocketing, probably not if it's falling. But just remember, that's very, very different from a genuine investment asset. It can make you very wealthy. It has made people very wealthy, but of course that wealth is only worth anything if you then convert it back to normal currency. If you carry on holding it and it goes to zero, then you can see that wealth disappear very quickly.
I suppose this week in particular, speaking of Trump, the name that's been synonymous with Trump in the news has been Epstein, which obviously with the files and Department of Justice in the US releases something like 3.5 million files, which journalists have been trawling through this week. Not going to go into those, but some of the prominent names that have come out have come from the world of finance, and there is a concern that the individuals that have been named, does that then bring distrust and mistrust into the institutions they represented or continue to? If you were speaking to just an everyday retail investor who just wants to save for the long term, save their retirement, invest to send their kids to uni, and they're going, everyone's corrupt. It feels like everyone's corrupt. The whole system is working against me and my aims. What do you say to them in terms of how would you go and pick a trusted partner to look after your money? We're so emotional about money, and people really don't want to lose it. And at a point like this, I have a genuine concern that people have so much mistrust in the system and the organizations and the institutions that exist in it that people start stuffing cash under their mattress. And you and I both know if you're saving for the long term, you've got to be in the market, but people don't have that trust. How would you convince someone, or even just give them the confidence to go, here are the tools you need to go and pick a trusted partner?
Yeah, because I mean, it's just appalling. What we're finding out every day, and of course that naturally does impact on the reputations of not only those that are involved, and quite rightly, but the reputations of the organizations that they're part of. And because Epstein, of course, was in some ways involved in finance, then a lot of his circle seems to have been involved in finances as well. That naturally leads to mistrust and concern about the people that you're dealing with. I think what I would say in a 30-year career in financial services is that the industry is full of very good people who are working very hard to help investors. But we are all deeply flawed individuals, and those flaws tend to come to the surface when emotions are at their most extreme. So when people are feeling particularly greedy or particularly fearful or particularly threatened by something. And so we've seen that play out, not just in this recent appalling situation, but also in various sort of booms and bust cycles, going back as far as finance. For hundreds of years, there has been bad actors, and so it's incredibly important as a saver, as an investor, to avoid coming to the simple conclusion that all financial institutions are endemically corrupt. That's not the case, but also to assume that everyone is working in your best interests. Now, we're very lucky in the UK. We have a very strong regulatory system that is there to protect investors. That's true in the US and other parts of the world as well. And those regulators are working incredibly hard to try and root out the bad actors. But I think it's even more important to understand that as an investor, then you want to find an organization that is aligned to your values and aligned to your interests. So in the US, a lot of financial advisors there have a fiduciary duty. Their duty is to put their end investor first. And although we have slightly different rules here in the UK, we have the consumer duty. We have an emphasis on financial advisors in the UK always finding the right solution for their clients, putting their investors first, and that's incredibly powerful. As you know, I recently set up a new business, and the first thing that I did when I set up that business was to set our investing principles. And principle number one, the most important, is that we put investors first. And that's not a marketing gimmick. It's because I know that as a human being, I am deeply flawed. We all are, and people that come and join this business over hopefully the next few decades will also be deeply flawed. And so we have to keep reminding ourselves every minute of every hour of every day that what we do whenever we're making a decision, whenever we're trying to help investors, is that we put their interests first. Now, we're not alone in that. There's lots of really excellent organizations out there which operate on similar principles. Some are explicit, some are implied. If you're working with a good independent financial advisor in the UK, then I'm sure they'll look after your interests in the US and elsewhere as well. But just make sure that when you're dealing with any sort of financial institution, that they have guardrails in place to make sure that they're operating in your best interest, and ask them about it. There is absolutely nothing wrong with talking to whoever the representative of the institution you're dealing with and finding out how those guardrails operate. You'll get a lot of good information from those conversations, and hopefully spare yourself from a lot of worry and potential heartache down the line.
I don't know if I've ever told you this, but you are in the first paragraph of the book I'm writing on finance, which is called "Teach Me About Money," and the paragraph is in my birthday card for my 30th birthday. You wrote, "Your 30s is your best decade because it's when your pension becomes exciting." And it was it was so true, and it has become increasingly true over time. I am now in my getting on for my mid-30s. I have a family, I have a career, but I have all the things that come with being in your mid-30s, you know, a mortgage, a car, you know, school fees and all the other things that come with it. One of the big issues I think with people who talk about money, particularly on the internet, who are influencers or, you know, financial professionals, they are not most people tend to be earning a lot of money or their employment structure is very different. So if you are a pay-as-you-earn employee with all of the baggage that comes with being an employee and all the debt and all the commitments, things like that, at what point do you say, I need a financial advisor? Because
Mm.
I meet lots of people who go through life who will start to take financial advice when things like their parents die, because that's when they then inherit money. But I think we have a massive issue, particularly in the UK, of financial illiteracy. If I was the chancellor, one of the things I would bring in is give everybody 2 hours of free financial advice every year. I think that would solve significant issues for the government, and particularly when it comes to pensions. But if you are just an everyday working person who just wants to get their money in check, who just
Mm.
wants to make sure that they've got a plan and it's set, when, in your opinion, is the best time for them to reach out or engage a financial advisor?
Yeah, so that is a really good question, Kez. And by the way, I'm delighted to be in your book. I didn't realize that. Thank you. So yeah, listen, it's the kind of so unsaid question there, again, is that financial advice has changed over the last 3 decades. When I joined the industry, the costs of providing financial advice were far lower. The remuneration that came through various financial products like pensions and things like that were frankly higher, and the fees were higher as well, and that meant that more people could engage with financial advisors. So one of the great things that happened over the last 30 years is that the fees on financial products have collapsed. It's much cheaper now to save and invest in terms of fees than it was when I started my career. The drawback is that, of course, that's what used to pay for financial advice, and so that's not so available. And so the sort of short answer is that the advisor will tell you if you're in the kind of wrong position to take on advice, because I mentioned Consumer Duty earlier. They need to make sure that they are looking after you on an ongoing basis. They have to be paid for that. And so if they don't think they can provide value, if they don't think that you're going to be able to pay for that, and you see value in it as well, then they're not going to take you on as clients. So don't be put off finding a good independent financial advisor. But I think more generally, when you think about advice, your need for advice changes through time. And so so I have a financial advisor, and when I talk to my advisor, then actually a lot of what we're talking about is the protection aspect. So insurances, and the reason we're doing that is that I've just, as I mentioned, set up this new business, and so the protections I had, the life insurance, the health insurance I had as part of my old job, I no longer have anymore. And so then we need to reassess what would happen if something happened to me, to the family, and make sure that we're protected. Previously, we've spoken more about investment things as well. So there's think of seeing a financial advisor as a bit like an MOT. When you take your car to have its MOT, there's normally some things that you're a bit worried about. Some clunking in the background. You think, I think my exhaust may be coming off, or whatever it is. But the garage often finds things that cause it to fail the MOT that you didn't know about. And so I'd encourage everyone to reach out to a financial advisor. They will tell you if they can't help you, but do speak to them. Almost all of them will spend an hour with you, just finding out your circumstances, getting to know you, and often kind of giving you some very useful tips then, or telling you that you don't need to work with them. The other thing I would say is just keep it simple when you're making investments. I think there's always a temptation to try to do too much, to take too much on yourself. But when you're saving for the long term, the simpler that you can keep it, the more you can reduce costs. And there's plenty of books and articles out there, and I'm sure your book will cover this as well. Then the better you're likely to be. So if you remember those two things, whatever your circumstances, if you're doing any sort of saving or worrying about your family or planning, all that sort of thing, speak to a financial advisor. And then if you are making those decisions by yourself, then keep it simple.